All right. Good morning, everyone. Thank you for everyone who's taken the time to be here today. This is our BEST seminar, which is an acronym for Business Education Seminars and Technology. It is something that the village has been putting together for all of our businesses. We do a quarterly BEST seminar in an effort to help our small businesses and large businesses grow. Today's topic is related to tax savings. And if your business was a business that paid its employees during the pandemic, you are in the right place because you're going to learn how to take advantage of some tax credits and savings for your business. We have two speakers today. One of them is going to talk about the overall, if you're a business that had employees on your tax rolls. And the second speaker is going to be a little bit more specific about restaurant businesses. So hopefully you will find this session very informative. I'm going to hand the microphone over to Gail Tobin. She's the chairperson of our Economic Development Committee. And the Economic Development Committee actually is a committee that is made of representatives from the business community, and we get together once a month. Today is one of those days, the second Tuesday of the month, to help figure out what we could be doing, what the village could be doing to help our businesses. And we try to come up with topics, variety of topics. Sometimes it is related to marketing, sometimes education, sometimes it is tax credits, et cetera, to help our businesses. If you have a topic that you would like us to focus on, please let us know. We have a meeting right here in this room, room 214 of the Village Hall. We meet at 12:30, second Tuesdays of every month, and we would love to see you. With that, I'm going to hand this over to Gail Tobin.
Thank you. Thank you, Shubhra. And as Shubhra said, my name is Gail Tobin. I am the chairperson of the Hanover Park Economic Development Committee, and we are volunteers from the business community who are here to help the businesses and be advocates for our local community businesses. We're bringing today's program in partnership with our regional partners, the Bartlett Area Chamber of Commerce, the Northwest Hispanic Chamber of Commerce, the Schaumburg Township District Library, and the Women's Business Development Center. So hopefully you'll get some great tips today at today's session. I wanted to introduce our first speaker. Laura H. Johns, CPA, is the Vice President of Client Engagement at Tax and Beyond. Laura began her career at a small Chicago CPA firm in 1989. After spending 3 years in public accounting and earning her CPA designation, she went on to serve as controller at a commodities brokerage startup. In her role there, she created an employee manual, established an employee benefits program, and provided systems to manage the accounting and finances of the business. Upon completion of these goals, she left the brokerage firm to begin her career in real estate, both sales and as an investor. In 2007, Laura returned to a career centered around helping individuals navigate their tax savings opportunities. Within the tax industry, she served as an instructor, a media spokesperson, and most recently worked as a tax training developer, providing continuing professional education for tax professionals. Throughout her career, Laura has continued to serve her small business clients as their tax and business advisor. In her current role, Laura works with new and existing clients to ensure they are leveraging the talents of the entire team to maximize the benefits of her expertise. Laura earned her Bachelor of Science degree in accounting from Northeastern University in Boston, Massachusetts. Please welcome Laura Johns.
Hi, everyone. I've been asked to mention that this session is being recorded and will be made available at the Village's YouTube channel. Is that correct? Did I do that right? Okay, good. So how many of you have heard of a tax credit before? It's kind of a mainstream concept, right? We know about tax credits. Most tax credits are tax credits that we claim when we file our individual income tax return, which generally for most of us happens in April, right? And we're familiar with the concept of filing an income tax return and taking advantage of benefits that are available at that time. Something that the pandemic did was, and I love using the word unprecedented, because by the time we're using the word unprecedented, there is now precedent, right? So, so we now have new precedent. Never before had we had an opportunity to claim a tax credit, let alone, I should qualify that and say a refundable tax credit on our payroll tax filings. And that has all changed now as a result of the CARES Act. So we're talking about a piece of legislation that was put into action in early 2020. I don't know about you guys. I kind of have COVID calendar. Like, it's really hard for me to remember what happened when. So if you don't mind taking a stroll down memory lane, the CARES Act was really the first piece of legislation that's aimed to inject some life into a stalled economy. And so many, many things came out of the CARES Act. And one of them was something called the Employee Retention Credit. So the Employee Retention Credit is the focus of what I want to talk to you about today. But at the same time the Employee Retention Credit came out, everybody was learning about the PPP. And I have to say, I think of the PPP as the ham of the two, because the PPP really stole the show, right? Everything was about the PPP. It was low-hanging fruit because banks were readily talking about it. It was relatively easy to obtain, and it sort of swallowed up the media space for all things tax and economy-driven. So the PPP, at first, it was unclear as to whether or not you could claim a PPP and benefit from employee retention credits. And so even the accounting professionals were focusing their attention on the PPP because there was an understanding that it was mutually exclusive with regards to the employee retention credit. Fast forward many, many months, the IRS came out and said, oh no, we never meant that to happen. What we meant was you can't use the same wage dollars that you use to justify PPP forgiveness, and that's quite a mouthful. You can't use the same wage dollars that you used to justify PPP forgiveness and as you would use for the ERC. So that you, as long as you can have wage expense that is in two separate lanes, you can absolutely benefit from both opportunities. So now the industry is scrambling, oh shoot, I guess we better go back and learn more about this ERC and help people understand it, okay? It was still pretty well known that in order to benefit from the ERC, your income would have had to have plummeted as a result of the pandemic. And that was true, and so a lot of people had the conversation, oh, did your income drop off by more than 50%? And if the answer was no, they kind of moved on to the next conversation, and that made sense at the time. But then the IRS came out and they thought, well, the economy isn't really improving and the pandemic is kind of lingering, and I think we need to extend this program into 2021. And so they extended the program into 2021, and they said, your income could have dropped, but instead of the 50% plummet that we were looking for in 2020, now we're only looking for a 20% drop-off. And whenever we're measuring a drop in income, we're measuring our income based on pre-pandemic income compared to pandemic income. So the pre-pandemic income was measured on a quarterly basis for the year 2019. That would be our base year. And then we would take 2020 quarter by quarter and compare it to 2019. And if we saw income drop by 50% or more, we had eligibility. Then move on to 2021, we're still comparing 2021 to 2019. So if 2019 is our base year and it was our pre-pandemic year, it's a lot easier to achieve a 20%, not that achieving a drop-off in income is an achievement, but under the circumstances, if you had a 20% drop-off in your income in 2021 compared with 2019, we have eligibility based on a reduction in income, okay? So now we have a situation where we're looking backwards for people because the payroll tax returns have already been filed for these periods in many cases and now in all cases. And we are saying to our clients, hey, it might be worth going back and amending your quarterly payroll tax returns to see if there's a eligibility there. There are other ways to be eligible. So there are 3 in total. One we've just discussed, which was if your income dropped off. And that was yes or no, black and white, simple math. It applied or it didn't apply. We can figure it out for you in a matter of, minutes once we have the information from you. The newest way that I find in my conversations the fewest people are aware of is that if you started a business after February 15th, 2020, why is that date significant? It's a random date, but clearly it's once the pandemic had begun, right? So the idea was if you were so audacious as to start a business where you were paying employees during the midst of a pandemic, we, the government, want to say thank you. We want to lift you up. And so for those businesses and those businesses alone, if they had employees, and by the way, in all cases, when I'm talking about employees, I'm talking about employees who are not related to the owner. Not the owner and not related to the owner. So simply having someone on payroll isn't quite enough. It has to be an unrelated person on payroll. And then we have a qualifying employee. So if you had a new business and you started during the pandemic and you had employees who are not related to you, you're going to qualify. There's only one thing that could knock you out of the ballpark for this one, which is having had a business previously where your gross receipts were over $1 million over the prior 3 years. So as long as we're talking about a relatively small endeavor, if you were a new business, started after February 15th, 2020, you had employees in the 3rd and 4th quarter of 2021, those are the only 2 qualifying quarters for a new business, then you qualify. And as long as you paid people enough, and we can talk about that, but as long as you paid people enough, you can benefit for $50,000 in each of those 2 quarters. So the maximum for a new business is $100,000, assuming that they paid people enough. We'll get back to that. So we've talked about income and we've talked about new business. The third way to qualify, and this is where there's a lot of gray area. The third way to qualify is Congress got together and said, well, if your business was significantly impaired based on a government-ordered shutdown. Now, we're in the state of Illinois. We had a statewide shutdown. It's a fact. It happened. There are dates. It began on date X, and I say X because it was different for restaurants than it was for other businesses, but it began on one date and it ended on another date. And throughout that time, there were policies in place that for some businesses were very impactful. And I don't know about you, but when I hear the word very impactful, I go, define very impactful. The IRS uses the term significantly impactful. Define significantly, right? So sometimes the IRS creates policy that's strategically designed to be vague because they want to reserve the right to look on a case-by-case basis. But those of us who have been in the business for a while sort of know how the IRS is going to think and how they're going to approach things, and so we bring our expertise to the conversation. So for us, and the only guideline that has a quantifying element to it that the IRS has provided is they define significant as more than 10%. It doesn't have to be revenue related. So 10% of what? Gives me pause. Did you have weekly meetings in your office that were designed to support a program that your business had and you weren't able to have those meetings? Did you have those meetings once a month, once a week, twice a week, and you had to stop having those meetings? 10% of your meetings had to fall off. 10% of your attendees at your meetings had to fall off. Take it however you want, but 10% is the threshold. So it doesn't have to be 10% of revenue. This is unrelated to revenue. This is just that your business was impacted in some segment that represents 10% of something, right? So if you think about an office that had a full staff and then they had to change over to a rotated schedule to reduce density because of capacity limitations, that's a consideration too. Now, I'm not going to pretend that a business that was deemed essential, that's going to be an uphill climb to say that that business was significantly impacted. Essential businesses generally aren't going to qualify under the shutdown provision. So the essential business really needs to look to an income reduction. But for many other businesses, here's the truth of the significantly impacted concept. I don't know what it was like to live in the shoes of you, your business owner, in the past tense as you struggled to make your way through the pandemic. Only you know to what extent your business was impacted. So I'm reliant upon you to talk to me about how your business was impacted, and together we'll decide if we think that gives rise to significant impact to the tune of 10%. But if I'm having trouble and you're having trouble, I also can anticipate that an IRS auditor will have trouble. So it's really incumbent upon you to use your memory and your personal experience to create a narrative for yourself that we can park in the file so that if and when we claim the credit and the IRS wants to come back and ask questions, it's very fresh in our minds. Oh no, I was impacted, this happened, I couldn't do this, I had to do this, I had to change this methodology, okay? So just to give you guys a visual, a really easy qualifying business happens to be one that we're going to be talking about a little bit more as we continue the session, which is people in the restaurant business. Anyone in the state of Illinois who owned and operated a restaurant business, who had employees who were not related to them, and had to switch from dine-in service to takeout or delivery only, they qualify. That's just a slam dunk. They qualify. And governments in the state of Illinois had to close at 9 p.m. on March 16th. So I know not everybody who's not in the tax business thinks in terms of quarters, but March 16th is a sliver of the first quarter of 2020. And so we're looking at part of the first quarter of 2020, the second quarter of 2020, third quarter of 2020, fourth quarter of 2020, first quarter of 2021, and if you remember, the state reopened on June 11th, which means that we're substantially through the second quarter of 2021. Okay, so there are a lot of quarters here that qualify. Why are we measuring income based on quarters, and why am I speaking about the credit in context of quarters? It's because the form where we claim the credit is filed on a quarterly basis. So this is a quarter by quarter process, okay? So we talked about the narrative of sort of how this kind of thing got started. We talked about the 3 different ways to qualify. Now I just want to spend a few minutes on the math, okay? I will start with a headline, which is 2021 has much more opportunity if we define opportunity in dollars. 2021 has much more opportunity than does 2020 for this reason. In 2021, the limits, the quarterly limits, were just that, they were quarterly. So an employee could earn up to $10,000 per quarter and be eligible per quarter. So we just talked about an example where we're looking at one and substantially all of 2 quarters in 2021, but think about the business whose income plummeted by 20%. We're looking at a potential for quarter 1, quarter 2, and quarter 3 of 2021. So any employee who they paid up to $10,000 will generate a credit of 70% of what they were paid. So let's say someone were paid exactly $10,000. They're going to generate a credit of $7,000 per eligible quarter, okay? So just for simple math, because I don't want to shave off part of the first quarter of 2020, and I don't want to shave off the end of the second quarter in 2021. If we talk about the person who qualifies based on a reduction in income, we're talking about 3 pure quarters in 2021. That translates to $7,000 per employee per quarter. So I'll just do it for us, $21,000 per person, max. Okay, so if you're thinking, oh, I only had 1 employee, okay, but you had an employee, right? So it's not about, oh, it's not going to be very much for me. It's not going to be a big, sexy number. Dollar refunds are refunds, right? We want our tax refunds. So let's go get them. The government wants you to have them. We just have to go claim them. So in 2020, the math is different. The $10,000 limit applies to the whole year. So once an employee reaches $10,000 for the whole year, they're at their max. We don't have to look at any additional quarters. And the rate was not 70%, it was 50%. So we're talking about $5,000 per employee for the entire year of 2020, okay? But here's the thing. I've seen businesses with high turnover, and they're earning more money in ERC credits in 2020 than in 2021, just based on the level of turnover. So it really is important to look at each business on a case-by-case basis and not sort of assume that this isn't going to be a credit that applies to me. So the questions we want you to ask yourselves are, did I have employees who are not related to me? Yes. Did I have an income reduction that's defined as significant? Maybe. Was I impacted significantly by the government-ordered shutdown? Yes or no? And then was I a new business? And if you had employees who are not related to you and any of those things apply, we want to talk to you because we think that there's value there in claiming the employee retention credit. Now, whenever something like this comes into the marketplace, there are places and people that seek out the opportunity to get their piece of the pie. So I want to caution you about what's happening in the marketplace. There are businesses who have come into existence simply as a result of the ERC credit. And they're out there marketing themselves as people who can help you claim the credit. And that's great. The problem is if they don't have a tax background, they might not be able to speak to you about the tax implications and the follow-up items that have to happen with respect to your tax return. These credits are effectively taxable, so I'll leave it at that, but just let you know there might be an amended tax return on your income tax return that's necessary. So I'd hate to see somebody pay a high premium for an opportunity to work with a firm that may not even be around when the time comes for you to need to file your amended return, let alone if the time were to come when the IRS is going to come back and ask questions. So the good news about working with us is we are an accounting organization. We do this. We know what it means to exercise due diligence. We know how to dot our I's and cross our T's. And we're going to have what's known as an audit trail ready at the ready in case the event happens where the IRS circles back and asks questions. So I just want to recommend, whether you use my firm or you don't, that you seek the help of a tax expert when pursuing the employee retention credits. And I think that I have a couple of minutes in case anyone has a question, but that pretty much wraps up what I wanted to convey to you all today.
Clarification. So we have lots of small mom and pop businesses, and they may employ family members, so they will not.
They would not be eligible if their family members are related to them. The only exception is if they hire a cousin. Everyone else, including in-laws, are off the eligibility list. Oh, I see pouting. I'm so sad. Yeah, so it is a challenge if you don't have arm's length, unrelated employees.
And is there a deadline for filing?
Great question. So like many tax filings, the deadline is based on the original filing deadline. And so the very first original filing deadline that we're going to come upon is the second quarter of 2020. And the deadline to file an amendment for the second quarter of 2020 comes up in July of 2023. And I always get nervous about saying that because I feel a lot of people think, oh, good, I have plenty of time. And I just want to say, now's the time to get started. Number one, we want to get in the queue. The IRS is inundated right now, and as I'm sure you are all aware, they're short-staffed. They've been infused with budget money specifically to support this program, but you kind of want to get your claim in the queue. Not because as long as you're postmarked in time for the statute of limitations, you would be okay. But I worry that it could get messy if there was a close call on when your documents were received. And right now it's taking a month for certified mail to go from our post office to the IRS's log-in recognizing that you sent it. And that's just for the ERC program. So yes, we sent it. Yes, you received it. There's usually a month in between. So we don't want to just rest on our, oh, I have plenty of time. We really want to be proactive and get in the queue and get set up. And then part of our service is that we, as a courtesy, take power of attorney from you so that we can contact the IRS periodically and make sure that your documents are in the queue, that they've been assigned to an employee, that they give us an estimated time of arrival of the checks eventually. So we have a system where we follow up as well, so you don't have to do that. In other words, we spend the hours on the wait time hold so you don't have to, right? Because it's funny, what we find that happens is at first people are like, oh, wow, this is free money. It's coming out of nowhere. It's too good to be true. It's like winning the lottery. And then they sign the piece of paper, we take it from them, we get it certified, and they go, where's my money? So we kind of change from, oh, this is great, to what's taking so long, right? So yeah, we want to get in the queue. Anything else? Sure.
We're talking about getting in the queue and getting the process started. Approximately how long from start to finish do you think it might take?
To get the money?
Yes.
7 months, including that month where we're waiting to get in the queue. So the IRS says we're processing these within 6 months. So far, they're proud to be able to say that they have adhered to that, but it's 6 months from when they log you in, not 6 months from when we send it out. So 7 months. Now, again, I did talk about the fact that the infrastructure bill, which passed in November, included funding to support this program, and that funding and that program hasn't launched. So it is possible that there will be an opening of the bottleneck, and we're hopeful that that will happen. But at this moment, until we've seen something shorter than 7 months, we're going to tell you 7 months. Another question I get, which you all haven't asked, but I'll just answer for the fun of it. It's real. Like, people are getting checks. People are getting checks for hundreds of thousands of dollars in some cases. So it really is real. They're paying interest because technically the time for these credits to have been, for you to have been eligible has passed. So whenever your eligibility dates back to, the IRS will also pay interest plus the credit. So, good deal. Well, I'm sorry for the mom and pops, but for everyone who has employees, even if it's just one or two who aren't related, and remember, it's at any time during the eligibility time frame, we think it's worth a conversation. Thank you.
Thank you, Laura. That was really important and helpful information for our businesses to know. And now we're going to shift gears a little bit, and we are going to continue on the tax topic, but does your business sell food and beverages? You're going to learn about the food and beverage tax forms that are required to be completed, and our presenter today is Linda Chambers, the Assistant Finance Director with the Village of Hanover Park. Thank you.
Thank you for that introduction. So yes, I'm Linda Chambers, the Assistant Finance Director here at Hanover Park. Today, I just want to do a brief overview of our food and beverage tax. So I will just jump right in. So what businesses need to charge for food and beverage tax? It's pretty simple. Any retail food facility. So what you'll see on the slide here is actually directly pulled from our ordinance. I'm not going to read it word for word. It's a little complicated. But basically, any business, so you're talking about restaurants, bars, coffee shops, cocktail lounges, even like a grocery store, deli counters are all considered retail food facilities. So they are all required to collect the food and beverage tax. There are a few exceptions to this rule, so things like schools, churches, hospitals, daycares, any sort of facility that's related to a nonprofit association is not required to collect or pay these food and beverage taxes. Some quick definitions I'm going to put up here, once again, pulled directly from our ordinance. I think two of the most important ones here are the definition for alcoholic liquor and food and beverage. So alcoholic liquor is just any form of alcohol, spirits, wine, or beer that is sold for consumption at the location or packaged for consumption off the premises. So food and beverage includes any and all material or commodities, whether they're solid, semi-solid, liquid, to include both alcoholic and non-alcoholic beverages, used or intended to be used for human consumption. So generally these food items are prepared at the restaurant or at the deli counter, and then they're sold for people to consume either there or once they leave. So what is the food and beverage tax rate for Hanover Park? It is currently 3%. So any restaurant or retail food facility needs to collect 3% in tax from the customer, and this is on top of any state or county taxes. So if you are a business in Hanover Park on the Cook County side, you should be collecting 13% tax on all of your sales, and if you're on the DuPage County side, it would be an 11% tax. It's really important to note here that if you fail to collect any of these taxes, your business is still responsible for paying them all. So definitely go back, check your registers, make sure they're ringing up properly with that tax. This is a way a lot of businesses, when they first open, they end up losing money on their profits because they didn't collect all the proper taxes, but they're still expected to pay it all to the state, the county, and the village. Okay, so the village has two tax forms that they require businesses to fill out. The first one is just the food and beverage tax registration form. So businesses only need to fill this out once, and is when they first register as a food and beverage business within the village. It's a pretty simple form. We do ask for a lot of information, and that's so that we can get a hold of both you as the business owner, your business manager, or your accountant to make sure all of your filings go properly. So I'll just go through it. It's kind of hard to see up there. But we ask at the top for the applicant name and their number, the business name, number, and the address within the village. If there is a different owner or manager, we'll get that information. We want to know if you're a sole proprietorship, a partnership, a corporation, or other type of business. You will need your retail occupational tax number and your federal employment identification number. That just shows us that you are a legal company and you have registered properly. We'll also ask in section 2 for your accountant's name and their phone number, and if they have a different mailing address, this is the person we will go through for your filings, and if there's any issues, that's who we would want to contact. And then below that, we also ask for how you're filing with the state. So through the state, you'll file an ST1 or ST2 form, which is the form the state requires to know your sales and the taxes owed to them. They allow you to file it monthly, quarterly, biannually, or semi-annually or annually. We just want to know that information because these forms are required to be sent to us as well. All right, our second form is the food and beverage tax return form. So this is required to be filed with the village on a monthly basis. The payment is due on or before the last day of each month following the collection period. So here I say if you're filing your March food and beverage taxes, they're going to be due by April 30th. So I will go ahead and go through the form with you now. So the first thing you're going to do is the tax period. In this example, I chose February of 2022. So that would be due by March 31st of 2022. You'll have your customer number, which is assigned to you when you complete your registration form. Our accounts receivable clerk will go ahead and process your form and then assign you a customer number. So you'll need that on all of these forms. You'll just put your mailing and business address. If it's different, if it's the same, just fill out one side. And then the next line is line 3 of your ST1 or ST2. So that's generally the total sales for your restaurant, and it should match line 3 of this form as well. Now, for grocery stores with deli counters, sometimes those lines won't match because the sales you have at your deli aren't the total sales for your restaurant. So you just need to double check and verify that form or that amount. But in this case, I just did an example, a simple one. We had $1,500 total sales. So on line 1, the food and beverage sales were $1,000. And then line 2, sales of packaged beer, wine, and liquor, we sold $500 in February. So you add lines 1 and 2, which gives you $1,500. So the village tax rate's 3%, so $1,500 times 3% is $45. So you would need to pay the village $45 by March 31st. There's plenty of ways to do that. You can come in and pay at the counter. You can pay online. You can mail in your check. I don't suggest it. As we heard earlier, the post office is taking quite a while to deliver just about anything these days. So a couple things. So if you pay late, let's say you pay this on April 3rd, what happens? Well, a couple things can happen. So you're either going to get charged the greater of 10% of the amount due or $100. In this case, 10% is $4.50. So we're going to be invoicing you $100 for that late payment. And those invoices are due upon receipt. What if you don't pay it still and it's a month later? So we have the ability to charge you an interest rate of 2% per month on the remaining amount due. So we don't charge any fees on the late fee, but we can charge fees on top of the amount still due. So basically, I know we're talking about ways to save money. A great way for businesses to save money is to just pay their food and beverage tax on time. It's not necessary for them to pay late. You already collect it, and then you just end up with unnecessary fees because you were unable to get your payments in on time. If you ever have any questions on these forms or how to file, or you're confused on what needs to be charged, the food and beverage tax rate, you can always give our finance department a call. We're always happy to help our businesses in any way we can. I did also attach here a link to the forms on our website, as well as a link to the ordinance for the food and beverage tax, which goes into a lot more detail on the specifics. Does anybody have any questions? Yes.
How does the people that sell food in a farmer market sell?
So a farmer's market, so I do believe if it's a village-sponsored farmer's market, you're not required to collect the tax, and it's also going to depend on the type of food. So if it's just like fruits and vegetables, that's not a prepared item. But if you're like a restaurant and you have a truck and you sell it, you would still need to collect that 13% or 11% tax.
If it's somebody that is selling cookies or selling tea that is preparing their houses, they need to collect it?
Technically, yes. I'm sure, I'm going to assume they don't have a business license because they just do it at the farmer's market, but technically, if you're selling any prepared food item, you need to have a business license and be a registered business. Yeah. Yes, go ahead.
You mentioned that they have monthly or quarterly, but then you said this form is monthly, so like.
Yes, so the ST1 and ST2, those are the state tax forms. Now, if your business is small enough, the state doesn't require you to file on a monthly basis. But our forms, it doesn't matter how large or small your business is, we still need it monthly. We do require that we get a copy of the business's ST1 or ST2, but that's why we ask when you register how you're filing with the state, so we can know when to expect it with your monthly form. And then we'll just do a quick math to add up that, let's say you file semi-annually, that your last 6 months equaled what you filed with the state. And that's just for us to, one way to verify that you are filing with us the correct amount.
So the city taxes are monthly and the state can be monthly or quarterly.
Yes. Any other questions? Nope. All right. Thank you.
Okay, thank you everyone for attending today. We'll be posting this presentation on the Village website and on the Community and Economic Development Facebook page, so you can view it again, and also the Chamber website. You'll have an opportunity to view it again at a later date, and I hope you found this information helpful. Thank you all again.